Everyone. We're going to get started today with our Selling Your Business webinar led by our Center Director, Raynor Large, up at AvCog through the main SBDC. He's going to be going over sort of the nuts and the bolts of what it takes to get you ready to sell. Go ahead and introduce yourself in the chat. Let us know where you're calling in from, maybe what industry you're in. If you have a business link you'd like to share with everyone else, go ahead. You can also submit any questions you have in there along the way, and there will definitely be time for questions at the end as well. So without further ado, I will pass it over to Raynor.
Great, thanks Kelsey. Good afternoon everybody, thanks for joining us. Go ahead and dive right in. It's 2 o'clock and got a lot to cover today. So I'm going to be talking about selling your business, kind of the steps it takes and considerations working towards that. A bit of background about myself. I've been here at the SBDC for about 2 years, but in the last 5 years I've also worked as a financial analyst for a firm called Magnuson Balfour, which is the largest listing business brokerage in the state of Maine. Along the path, I've worked with both buyer side and seller side in transactions. I've done probably more than 100 broker opinions of value, as well as valuations. I am a certified business appraiser with the International Society of Business Appraisers. So this is something that I'm fairly comfortable discussing. We have a pretty small group today, which I think is great. The advantage of a small business center is that we're very good one-on-one, and I much prefer kind of a discussion format than just a lecture. So as I go through this, if you have questions, if you have concerns, if you have issues that arise about how pertinent it is to your business, please feel free to jump in. Either unmute yourself and ask the question. I don't mind interruptions. I think any questions probably, if you have a question, someone else in the group probably has it as well. Or if you prefer, you can just voice it in the chat and Kelsey will draw my attention to it. So today, we're really going to cover quite a bit, right? And a lot of these things will overlap. So I'm going to set some expectations, talk about, my experience in the business brokerage industry. We're going to cover what you're selling, who's buying it, and what it's worth, all of which kind of work together. We'll also talk about some structuring the deal, some creative opportunities there. And then we'll end with some best practices working towards it, things to be considering if you're planning on selling in the future. So just some anecdotal expectations from my time at Magnuson Balfour. Only about half of businesses that are listed on the open market end up selling. So this isn't like commercial real estate. It's not like residential real estate. It's a long process. Average days on market is 18 plus months. So this isn't a quick turnaround. It involves a lot of planning, a lot of foresight, and because of the confidentiality aspect that you have, as well as the due diligence required from the buyer side, it's a long process. So I just want to, kind of keep that in your mind, setting that expectation. And then any business that involves goodwill, which we'll define a little bit more clearly later on, really does require a seller note, especially in today's market where lenders are becoming more and more risk adverse. So if there's not collateral there, if there's not a physical tangible asset to hold the loan, you may be involved longer than you expect to be. So that's, it's great if you have a cash buyer come to the table, but that's not all that doesn't happen very often. So what are you selling is really the first question. And I'm going to break it down and, and really focus on this. So what you're selling to a buyer is the ability of your assets to demonstrably demonstrate cash flow in a reasonable time frame. And there's a lot to unpack there, right? So what you're doing is you're selling your whole business, which is all the systems and policies and procedures and work that you've put in. But from the buyer perspective, what they're buying is the ability of those tangible assets to generate cash flow for them, right? So if that business isn't generating cash flow, then it's just worth the physical assets. And that demonstrably generate cash flow is something that I want to point out. In Maine, and there's a lot of good small business owners that don't pay much in taxes, right? There's a lot of strategies involved in that. And that's great. I'm not here to slap your hand or tell you to pay more in taxes than you have to. What I am pointing out is that if a buyer comes to the table and they're looking at your tax returns and they're saying, you haven't made any profit in the last 3 years and you expect me to pay for the systems in place, but those systems aren't generating any cash. And your response is, well, it generates cash, I just don't show it. There's a lot of room for negotiation there, right? And interpretation. So the demonstrable part is very important. It has to be provable and it has to be legal, right? So easiest way is to just pay your taxes. There are appropriate ways to kind of do that, whether it's through a manager's salary or accelerated depreciation, or just work with your accountant to make sure that you're reducing your tax burden. At the same time, you can point back and say, okay, here were one-time expenses, here was some capital reinvestment in the business, here were some owners, sellers, discretionary benefits that I took. Education is one that I see all the time. A vehicle is another one. Those are demonstrable. It's perfectly legal. It's a benefit, right? It might not be necessary for the primary method of business. So a buyer might look at that and say, well, I might use that cash differently. I might use that cash to support debt, right? And that's the real question. The business that you're selling has to be able to pay for itself. So a buyer can't pay you up front and then be sunk by the cost of the debt that they're putting on it. It's a new company buying the assets of the old company. And so that consideration, if they're overpaying for it, it doesn't work for anybody. Right? They're going to sink the company, your legacy, your business, your little baby is going to fail. So it has to be some kind of negotiation where that cash flow can support the purchase price. And the reasonable time frame is the last piece there, right? So if a buyer is coming to the table and they have a commercial loan is going to be limited to the life of the assets that they're purchasing, right? So if it's furniture, fixtures, and equipment, 5 or 7, maybe 9 years. It's real estate, 20 or 30 years. The cash flow from the business has to be able to pay that loan off in the lifespan of that equipment that they're purchasing. So if the cash flow isn't able to do that, all you're doing is setting up the buyer for failure. And there might be some buyers out there who go for it, but by and large, the buyers have their own accountants, their own attorneys, their own brokers, their own advisors looking over their shoulder and saying, hey, you're not going to be able to do this correctly. You're not going to be able to pay what the asking price is. Which kind of leads us right to the next section, which is who's buying it. So as a seller, your first consideration is, okay, how do I demonstrate the cash flow? How do I demonstrate the value that these assets are creating for the seller or for the buyer? The second question is, okay, who's going to buy it? Who's going to buy this, right? First and foremost, maybe 20 to 25% of successful sales that I've seen are staff or family. It's an internal transaction, right? It's a low risk. The people who know the business best are right there. And it's an easy transition, right? They just step into the ownership role. So they're buying, the buyer, from a buyer perspective, they're buying a continued job. And they use a commercial loan or a seller note. You work with them. There's some negotiation to make that work. Yes, sorry, Steve. So yes, great question. All of these slides will be available to you, as well as a recording of this. So if you want to go back and look at it and kind of keep track or see what you've missed, or you need to run to the bathroom and come back, that's fine. Yeah, you'll be able to see that. So the advantages of a staff or family transition are that you probably already know who's going to step in place. There's more room for negotiation because you can work with them. And there's a high likelihood of success. Now, the disadvantages are those employees, that family member, might really be relying on you, the seller, to hold a note. Right? They might not have a lot of equity. They might not have a great credit score. So they're looking to you to be the bank in that situation. Right? Now, if you bring it to the open market and you have someone coming in and replacing you, working 40, 50, 60 hours a week in your shoes, then they are buying themselves a job in a very similar situation. They are more likely to have personal assets that they can leverage up. So it's less likely that you'd be required to play the role of the bank. But the disadvantages are that if there's a commercial lender involved, or if they're a true independent third party, then they're going to be looking for a good deal. Right? They're going to be looking to negotiate heavily with you, make sure that they're able to really justify that cash flow purchase of the business. Now, there's a third option which we don't see very often, which is a synergistic buyer, right? A competitor or a larger conglomerate coming in and buying your business. Now, the advantage of that is that they're really buying a market share. So they're only looking at your top line. They're saying, okay, how many sales, how many customers do you have? Because all of the expenses you have in your cash flow, they're going to replace, right? They have their own staff, they have their own accountant and legal fees, they have their own insurance. All they're doing is buying the market share, maybe the location. Where we see this most often is like a legal practice where you're buying a book of business, or an accountant, or sometimes medical space. So then they're really focused on that top line. The obvious advantage there is that they have their own successful business that they are leveraging up to acquire yours. So it's very rare that a seller note's involved in that position. Disadvantage is that there's not many of them, right? You can probably count on one hand the likelihood or the possible buyers of that kind of scenario. So those are the three major sources of buyers that we find in a sale of a business. And each one has its advantages and disadvantages. So asking yourself what it's worth. I talked a little bit about it with the synergistic buyer, and we're going to break that out for a moment and leave it. And I'm just going to focus on the staff, family, and owner operator, someone buying a job, right? In both of those cases, what it's worth is really determined by three things, right? So the floor value for your business is an auction, right? It's a sale. Now, if you have bad customer interaction, or your employee leaves and you're sick of it, and you just want to close your doors, that's fine. That's one way to sell your business, right? You go to Keenan & Keenan Auction, you say, here's my list of assets, get me the best price you can. I'll collect my check in 2 weeks or 3 weeks. So that's the floor value, right? Now the ceiling is really the buyer's alternative, is one way to think about it. It's saying, okay, if a buyer was to look at this business, at some point they're going to say, instead of paying the seller, you, $1 million, I can spend $700, go out and buy the equipment. I can, have my my cap ready to go, my $100,000 in the bank to kind of work through my kinks. I can buy my inventory. Their alternative is to start up a competition, right? And if that alternative, working capital, everything that goes into it, is less than you're asking for, they're going to go with the alternative every time, right? So that's the ceiling value. And saying, okay, at some point you're just going to be asking too much, and they can walk and go do something else with that money. And then there's the market price, which is somewhere in the middle. And the market price is saying, okay, if the cash flow can support a value that's greater than the value of the tangible assets, then there's some goodwill there, right? And so that's, I said, we'll revisit goodwill. That's kind of my definition of goodwill, right? It's, if your physical assets are worth $100,000, but the cash flow can support a debt of up to $200,000, the goodwill is the difference between those two. It's literally the ability of your cash flow generated by the assets to support value greater than just the assets themselves. So it's saying, how well are you letting those assets work together? That phone number, that menu that you have, the website, all of that goodwill, blood, sweat, tears, reputation, 2 heart attacks and a divorce, everything that you've put into your business, is that generating cash flow? Are those lessons learned allowing the physical assets to work together in such a way that it's creating more value as a whole? And so if you can say yes to that, and you can demonstrate that, then you're talking about a goodwill value that you can bring to market and sell. So one thing that you hear a lot about, is, I alluded to it earlier, is the difference between EBITDA and seller's discretionary earnings, right? So both, you start with your net income, which is the bottom line of your business, right? That's just on your Schedule C, it's the last line that you get taxed on. It's what's left over operationally from the business. Then you add back interest and depreciation. Interest because that's the cost of the debt, and depreciation because that's non-cash, right? It's just a tax advantage. And that gets you to EBITDA, right? And EBITDA is a term that lenders like to use. They look at it and they say, okay, this is the cash flow that the business generates to support the balance sheet, right? So EBITDA you can use to either pay down debt, you can use to increase your assets, or you can pay out to equity. So that's that piece. Now, for a small business in Maine, you're looking at that and you're saying, well, what about my cell phone? What about my vehicle? What about my spouse's health insurance that I run through the business? All of those things are considered seller's discretionary. So that's this additional piece here where we're talking about, okay, I'm going to add back my salary and my discretionary spending, because what I'm trying to show a buyer is here's how well I live off of this business, right? EBITDA supports the debt and reinvest in the business, but I'm also making myself a living, right? And as a smart Maine business owner, I'm reducing my tax burden by doing that, but I want to be able to show that. So working with a broker or an advisor and figuring out, okay, what would I really be able to consider discretionary, and what passes a straight face test, right? That a buyer is going to come in and look at and say, okay, I can use that cash. I can use it the way they used it, or I can reinvest it in the business or do something else with it, right? Your vehicle, they might decide is better used to further their education, right? So they have an education line and they're getting their master's degree, right? And they run that through the business. It's discretionary. It's a way to say, okay, both of those are legitimate business expenses that you can expense, but they might treat it differently. So what you're selling is what you've spent and made as a discretionary earner, right? As the seller. So that's your seller's discretionary. What they're buying is the mirror image of that, right? So if they're buying your SDE, they're buying the ability to support debt, the ability to pay themselves, and then there's a buffer that the lender requires, right? The lender never lends 100% of the value. So they're going to come in and they're going to have their own salary requirements, and they're going to have their own debt need. Now, if that debt is greater than the ability to support it, so if you're asking for more than the cash flow can support, there's a difference there, right? So historic SDE, you look at the last couple of years and you say, okay, here's what I've generated from this business. If I have a reasonable down payment and interest rate and a term length, I can project forward and say, okay, here's the supportable purchase price. Now, if you're asking for more than that, that has to come from the buyer, right? And so that, it's not unreasonable. You can ask for more than that, right? I'm not telling you can't. The difference is you're limiting your buyer range at that point, right? So if you're asking for more than that, then the buyer either has to pay more down so that the debt itself is less, or they have to bring an asset to the table that's going to generate more in revenue. So it could be a skill set, it could be an additional line of business. That's where you're talking about kind of that synergistic business opportunity. And they're overpaying for the business, right? Because they have that asset. So that's where there's a real negotiation that comes into play. Because how much do they want to pay for it if they're the ones bringing it to the table? Obviously, you want them to pay the full amount, but there's some negotiation there. So the difficulty with that is that if the actual purchase price exceeds the supportable purchase price and the buyer doesn't bring anything to the table, an in-house sale, a family member, it's going to be over leveraged. Right? They're going to pay out more to service the debt than the business will make itself. And that's never a good situation. Right? So then one question that always comes up is, wait, what about multiples? Right? I've heard, 10 times my top line is a good multiple. And that's always suspect, right? It's too simplified is really what it boils down to. So going back to that original conversation we had, the top line multiple is appropriate for buying a book of business. So anytime someone says, oh, your business is worth 2 times your top line, it's only really true if you're an accountant, an attorney, if you have a book of business that you're selling, right? And if all the expenses don't matter because they have their own expenses and they're just absorbing your revenue. If you have, a typical convenience store or, retail service, and someone who's buying it is buying most of the expenses that are going to be the same rent, same utilities, same insurance, same payroll, then the bottom line is not going to change that much from them coming in. So they're looking at the bottom line and doing a multiple of the bottom line. So if you're going to use a multiple, identify your industry, identify the buyer first. So you make sure you're using an appropriate multiple, right? And then identifying what that multiple is very important, because a 2x multiple of EBITDA is very different than a 2x multiple of SDE, right? So identifying what's included, what are you actually multiplying, can make a huge difference in what you think the business is worth. And then, it's just a starting point, right? It's a rule of thumb at best. And it's really, that's where the negotiation begins, because what's identified as an add back for SDE, right? Is inventory included or not? That's a huge one. Gas stations that might have, several $100,000 in inventory at any given time. Is that included in the sale price or not? I mean, that could be a sticking point if you get to the day before close and one person thinks one thing and the other person thinks another. Quality and age of assets, right? We'll get to kind of that planning process, but if you allow your assets to kind of deteriorate and you don't replace that, you don't reinvest your capital, and a buyer comes in, they could say, yeah, it's a 3x multiple in the industry, but I'm going to have to spend $200,000 replacing some of this equipment on day one. That's a discussion that needs to be had. Vendor relationships, contracts, employee turnover. I mean, there's so many other aspects of the value to what you're selling that need to be identified and clarified in that process. So multiples can be a good rule of thumb. They could be a good way to start negotiation, particularly with that kind of in-house transaction where you have a ready, willing, and able buyer. But it's just the start, right? There's by no means set in stone, and there's a lot of room for negotiation behind that point. All right, any questions so far? Sorry, I haven't been checking the chat. And again, please feel free to jump in at any point. Understand we're covering a lot, and it's all new from a seller's perspective, I'm sure. So structuring the deal, there's quite a lot that goes into this, right? So a commercial lender this day and age is really focused primarily on physical assets, right? They want that security blanket of being able to say, if something goes wrong, we can take these things and go out and sell them. So real estate, furniture, fixtures, and equipment, inventory, those are things that they're considering. Now, loan to value ratios are important as well. And what a loan to value ratio is saying is that if a lender looks at $1 million building and it appraises at $1 million, they are not going to lend $1 million, right? Because they have to think about it. If we take that and we own it for a period of time, we have to turn around and sell it, and we pay a broker to, commission to sell it for us. We're not going to get $1 million out of it. So we want a buffer, right? We want 10%, 20% down. For furniture, fixtures, and equipment, it might be 30, 40, 50%. Restaurant equipment, you're lucky if you get 50%. Inventory is the same thing, right? It's what are they going to be able to sell it for compared to what do you have to buy it for, or what are you selling it for, right? So from the buyer's perspective, they're looking at it and saying, okay, we're buying those things, but I can only get a certain percentage of the value of it from the lender itself, the commercial lender. So then, if the value that you're selling, that the buyer and the seller have agreed upon, are greater than the value that the lender is willing to lend to, what's the opportunity there? Right? So first, you look back at the buyer. You say, well, what are you bringing to the table? Right? What are your personal assets worth? How much cash are you putting down? If they have a home with a lot of equity in it, a lender will often take that as backup and will lend more against the value of that home. Right? So you want to put that on the buyer as much as possible as the seller. But if it's an internal transaction, if it's a family member, if it's a longtime employee, you might be asked to hold a note, right? You might be asked to be a bank. So the lender has a first position on all of the assets, and you're there behind the lender with the second position. So you get paid a chunk of change on the day of close from the commercial lender. They write you a check, and you get the remainder of it over a period of time by being the bank with, an interest rate. Upside to that is you get the value of your goodwill kind of that back out of the business above and beyond the value of the assets themselves. Downside is, it's not immediate, right? You sit around, you wait, higher risk, obviously, right? If something goes wrong, the bank takes all the assets. What are you left with? A headache. Right? You could also be really creative with it, right? And this is kind of the fun part is once you've agreed upon a value with that, the goodwill value above and beyond the value of the assets, so the lender's not involved. So all of the lender's restrictions are kind of out the door. So if you want to say, hey, I'm going to keep my phone on me, and if you ever need anything, give me a call. In exchange for that, I want $50,000 a year out of the business and payroll, and I'm a consultant or something. Hey, as long as the buyer and seller agree, that's fine, right? You just make sure your attorney puts it in writing. If you want to be flexible and say, okay, in addition to the purchase price, I want 20% of the net income for the next 5 years. And if it does what I say it's going to do as the seller, then I win and you win. And if it's not as good as I'm promising you it's going to be, I take a bit of a haircut, right? So there's some negotiation that goes into that. And again, good contracts make good neighbors. So if you're going to be involved for a long period of time, make sure you have an attorney really identify kind of the issues there and put it in writing, right? Do you want some kind of oversight? Do you want the ability to regain control of the business for a refund of the purchase price at any point if you see it going wrong? What are the considerations there? Most sellers just want out and they just want to check every month. But sometimes if you're looking for that goodwill value, that's not really feasible, right? So you might have to stay involved. And then I just have ... because at that point, it's just a matter of creativity, finding some way that you, the seller, the buyer, and the business can all remain productive and happy. All right, so I'm going to pivot and talk about, okay, so we've talked mostly conceptually about that actual transaction process right now. I'm going to take a step back and say, okay, what do you actually need to do now? What can you be doing now as a seller to prepare for selling a business? If you're looking at the timeline, and you're saying, okay, if I bring it to market, it might take 12 or 18 months to sell. I don't even want to take it to market for another year. What should you be doing? Because there's lots, right? So the first thing I would do is try to make yourself replaceable, right? So you want to be very clear with any buyer stepping into your shoes that it's very easy to be you. Right? If you are the business, and a lot of business owners pride themselves on being the business, that's great. But how easy is it to transfer that knowledge? Right? If you're talking to a potential seller and you're saying there's no way you can learn what I can do, or you're talking to a buyer, why would they buy the business? Right? So policies and procedures, employee manuals, all that paperwork that you thought you were going to get around to and you just never did because you're in the operating side of the business, do it, right? Because you want to be able to say, here's everything, good luck. Send me my check at the end of every month. I'll call you around Christmas, you'll get a Christmas card. If you can't transfer that knowledge, it's not really sellable knowledge, right? It's got to be transferable to be sellable. And so the more effort you put into kind of making that process as easy as possible that you can just turn the keys over and walk away, the easier it is for a buyer to step in. And part of this process is opening that buyer door as wide as possible, right? You want as many possible buyers to come in the door as you can. Right? If you have a very narrow list of buyers and it has to be someone who's paying all in cash, doesn't do any due diligence, and has an MBA that they're bringing to the table, that's a pretty narrow margin, right? You might not find the buyer you're looking for. So the more you can do to say, anybody can do this job, the better off you're going to be. The second piece that you can start doing now is make your financials understandable, right? So the finances, the tax return that you file, your profit and loss, your balance sheet, your cash flow, That's the language of attorneys. That's the language of accountants. That's the language of commercial investors, right? So a buyer is going to bring professionals with them to the table. And those professionals are going to be trying to speak that language. And the more you're able to speak that language to them, and the more you're able to give them the knowledge they need to understand the opportunity and understand the work you've done in building this business, the easier it is for them to rubber stamp it and let the buyer pay for it, right? So if you're talking about, the more money you're talking about selling it for, the more due diligence goes into it, right? So you have to be able to justify it. Those financials are your goodwill. Those financials demonstrate the value of all of your systems in place. So, clean up your chart of accounts, make it simple. Take a look at your miscellaneous. If your miscellaneous line items, 10% of your revenue, make sure that's reclassed. Consistency is key. So if there's a lot of different charts of accounts and, 1 year it's office miscellaneous and the other year it's supplies. And then the third year it's, other, just make that more uniform, answer that question. It's going to be asked. Why are these different accounts showing different values? So take a look back. It doesn't take that long to do. You can combine accounts, you can trade things. You have to go through it with an accountant or an advisor or someone who knows what the questions are going to be. But make it simple, right? And then be able to explain year-to-year discrepancies. If there's anything trending up or trending down, you say, okay, my cost of goods as a percent of revenue went down because I switched vendors and I increased my pricing. That sounds great, right? You're able to speak to the financial value of your business. You sound like a very intelligent and well-educated business owner, and it makes sense. So if you can identify the questions that are going to be asked and have an answer ready for them, it conveys that knowledge. It assuages that uncertainty right up front. And then pay your taxes, right, is kind of the easiest way. Is they're going to want to say, okay, well, this is what your tax return shows. Doesn't matter what you show on your books. Anybody can keep a set of books. I want to see your tax returns. I want to see what you pay taxes on. So, use the legal and demonstrable ways of kind of reducing your tax burden, but make sure that those line items are easily explained. And then, just end with the time kills all deals is just an adage that is universal, right? So if they're at the table for 3 or 6 months before they can understand the financials and kind of weed through it all, and every time they ask you a question, you have to go to your accountant to find the answer, it's just going to be a rockier process, right? So being able to do that in a very presentable and straightforward manner will save you a lot of time and energy. So if you're 2 years out, if you're looking long-term, focus on that financial cleanup, that kind of acumen, understanding how to speak that language. Keep up on capital investments. I know there's kind of a tendency to say, well, I'm going to be out in 3 years and a truck can make it another 3 years. I'm just going to ride it. But again, replacing that asset's always a lot easier than negotiating about the value of that asset on the day of close. If they come back and say, well, now we have to replace the truck and it's going to be $70,000, and you're thinking, geez, I could have replaced it for $50,000, and you're talking about that. It's kind of a plan as if you're going to be there forever, and then be pleasantly surprised when you aren't, right? So keep on top of that capital investment. It makes the business look better. It makes you look better. And worst comes to worst, if that buyer falls through and you have to bring it back to market, you're not a breakdown away from a disastrous week. Start identifying your buyers. You can do that now. If you have someone in-house, you can start vetting them and kind of working with them, maybe set some money aside from their salary so they have a down payment, begin that management training process. If you have a number of customers or vendors that might be interested in buying your business, just in the back of your mind, kind of keep track of that list. If you're comfortable doing so, if you're not worried about confidentiality, approach them, run it by them, see what their interest might be. If it's a question of time and they're saying, well, that's great, I'd love to buy your business, but I'm 2 years away from a major acquisition like that. That's great. You're 2 years away too. But maybe they say, that's great, I'm 3 weeks away from my end of my fiscal year and I have all this cash and I'd love to buy your business. Aren't you glad you brought it up, right? So, confidentiality is a major concern for a lot of small businesses. An attorney or a broker go a long way. They can kind of get the confidentiality agreement. They can help you put together a flyer that is like a teaser. So, it doesn't disclose exact location. It, disguises the information enough so that a buyer won't be able to identify it's you, but might be able to identify whether or not they're interested. Then you get an NDA signed, and then you kind of disclose and work with them. But there's a process in place. There's an independent third party in that broker and that attorney making that connection. So you're never kind of outing yourself before you're ready. And then phase out your role, right? We've talked a little bit about this, but put those policies in place. Get that management team set up. Start taking longer weekends. Start taking, working a 50-hour week instead of an 80-hour week. See what it looks like. Kind of get a feel for it, because if you step out and everything falls apart, you can quickly identify what needs to be fixed, what needs to be filled, what is the operating or procedure, that needs to be put in place so that next time you step out, you can go 2 days without checking in, or 3 hours without checking in before everything falls apart. And then, the final year leading up to it, find your team is first and foremost, right? So the buyer is going to come to the table with their team, their accountant, their broker, their financial analyst. Make sure you've identified that. You probably already have your attorney. You probably already have your accountant that you've worked with for a long period of time. A broker is a great person to have in something like this. They have a lot of ability to work. There's a number of great brokers in the state. And just work with them. Say, hey, what should I be doing? Every one of them will have a different answer based on their profession. And they're all good answers, right? So you can kind of work through that checklist that they provide to you. Maintain full employment is another one that some people, it's the same idea as the capital, right? If someone leaves and you think, well, we can run kind of shoestring budget and I'm going to pocket a little bit more money at the end of the day before I transition this out. You can, but it's your team, your capital, your equipment. Those are all parts of your business, right? If your team is a little weaker, the business as a whole is a little weaker. So the easier it is for you to transition, here is my payroll, here's my team, right? And they're longtime employees. They've been in place. They know what they're doing. They run themselves. I can step out, you can step in, we're good to go. The better off that is. If a buyer has to step in and replace 3 or 4 employees right away, that's going to be hard, right? And it's less attractive of an asset at the end of the day. Clean up your balance sheet. Most transactions are called asset sales rather than stock sales. Asset sale is a new company is buying all of the existing assets of the current company, which means, it includes your goodwill. It does not include your liabilities, right? So you're responsible for paying off your liabilities. There's also what's called a stock sale, where they're buying 100% of the ownership of the existing business. So they're buying the liabilities of the business as well. For the most part, though, it's an asset sale in the state of Maine. So it's a new company buying the assets of the old company, right? And you're required to clean up the balance sheet on your own. Part of that cleaning up can happen beforehand, though, right? So if you have old inventory that's sitting on the books that needs to be liquidated or sold off, do that, right? If you have assets on the balance sheet that aren't necessarily pertinent to the business, go ahead and remove those. If you have the old mahogany desk in the office and you love that desk and you don't want to sell it, maybe move it out of the office so that if there's a walkthrough, if a buyer walks through, they're not assuming, oh man, I'm getting that nice mahogany desk. They're seeing, the oak desk that you use instead. Same thing with, vehicle or laptop, whatever you plan on bringing with you, just make sure it's identified as a personal asset, not a business asset, because they're going to want that asset list. So they say, okay, this is what I'm buying, right? If it's an asset sale, here's the list of all the assets included in that transaction. And then take time off, right? Take a week off, see what happens. Take a day off, take an afternoon off. Start with that. For most business owners, that's hard enough. right? Stepping out for a couple hours. At some point, you're going to turn those keys over. And the easier it is for you to not have to come back in that afternoon to fix some problem, the nicer it's going to be, right? And then the last thing I'd kind of say is that time off that you take, if you do it well and you do it properly, use to reflect, right? A lot of business owners, you're operational until the day the keys are turned over, right? You're working in the business 50, 60, 70 hours a week, which is great. It's been your whole life. You love it. You love that adrenaline. I hope it's probably worn you out at this point if you're contemplating selling. But the day after can be surprising, right? So take that time off. It's twofold, right? One is saying, okay, I've set everything up. I've set up those assets. I've made these assets, the policies, procedures, everything work appropriately without me. So I can step out. The second part is saying, okay, what am I going to do in the first week after my sale? You're going to work up until the day of close because you never assume the close until it closes, right? There's always going to be some hiccup, some delay, some negotiation. Maybe another buyer has to come in. At some point, though, you're going to walk out of that business. At that point, if you haven't prepared for that, it can be surprising. I don't know of another word for it. You don't realize how much it's become a part of your life until it's gone. So how will you handle someone else changing your baby's hair color? Is the analogy we use. Someone's going to step into your shoes and do something with the business. It could be exactly what you would want them to do and you're happy. It could be something entirely different, and you have no control over that. And how will you handle that? Right? So being able to look and say, okay, here's my plan for the first week, for the first month. Is it a hobby? Is it, another part-time business that I'm going to start? A lot of people, their next hobby just turns into their next business, right? It's all they've ever known. Nostalgia is common, but boredom even more so. If you've made a lifestyle of working, 50, 60, 70 hours a week, and all of a sudden you have that time back, it's not just the time you're there, it's those nights where you're thinking about it, right? It's the late night emails, the early morning phone calls, it's the, it's all consuming, and all of a sudden it's not there, you're empty. So, I don't want it to be that negative, but to be able to fill that space with something positive, start thinking about that. What are you going to do to invest in your life in the way you want it to look, in the way you want it to be? Maybe all you want is a good book, right? And, a nice glass of wine, but you go through that bottle pretty quickly and then you finish the book and then it's okay, what's my next book? So, have something there. And looking back, and talking about it and figuring it out, there are, business groups, there are ways to stay involved, particularly with the seller note. A lot of that becomes important for a business owner, especially with that internal transaction. There's a real opportunity to remain on as a mentor, to be involved, to be involved and continue helping that kind of heir apparent step into those shoes, which can be very rewarding. But make sure you have that opportunity contractual, right? If you're going to be looking over their shoulder, you want that to be understood going in. The last thing you want is resentment or uncertainty or a relationship that is, poisonous for both people. So if you want that to be part of your seller note of being part of that transaction, just make it clear up front. And I think that's, it's very important to have that communication ahead of time. So I think we've pretty quick class, only 45 minutes. Certainly lots of time left for questions, concerns. Covered everything.
There's a bunch of questions in the chat, so we are all set.
Perfect. Okay. So I'll start with the top. So concrete ways to demonstrate goodwill for a book or business sale. So book of business. So goodwill for a book of business So if you are selling a book of business, so if you're an accountant, an attorney, a professional practice, and you're selling that book of business, then the goodwill is almost implied, right? The physical assets are a side note to the value, right? So a book of business does lean more heavily on the value, the rule of thumb, multiple value, right? And that's more of industry data. And then you're going to look at history and how it compares. So longevity of those contracts, number of new clients. Every industry actually has its own benchmarks. So, reach out. I'd love to hear more about your industry and kind of talk through it. But like, medical practices, it really has a lot to do with insurance breakdowns, Medicare, Medicaid versus private insurance versus private pay. That has a real tangible value depending on which way it leans. Same with, dentist practices. I'm trying to think. For accounting, a lot of it has to do with the breakdown between like tax filing and repeat customers. So if 80% of your business has been with you for 10 plus years, that's a very transferable asset. If everybody's new, maybe not as much. So again, every industry is kind of unique. So reach out. I'm going to actually put my email in the chat. So if anybody has questions or they want to reach out to touch base, please do so. Strictly cash sale. How concerned do I need to be with whether or not the new owners will be successful? Will it reflect poorly on me if they crash and burn? Great question. It's entirely up to you. If it's a cash buyer and you get that check at close and you don't care, that's entirely, it's however you feel about it, right? I would spend some time introspectively thinking about it and say, okay, if that is the case, how guilty do I feel, or how frustrated am I that they did that? More importantly, with my baby, right? They went and killed my baby. But if you're sick of it and you're happy with that cash and you don't care, I'm not going to tell you to care, right? A cash buyer is rare. It's good freedom to have. I don't want to say that to the buyer, but try to put some guardrails in place to help them. Just make sure that the debt doesn't overwhelm them, right? That's the worst case scenario. How much do most brokers charge? It's a good question. It's always negotiable, right? So anywhere 5 to 10%, depending on how much marketing they intend to do and how much experience they have, is just kind of what I've heard anecdotally. Obviously, there's not price fixing in the industry, so I can't really share with you. I don't know what other brokers charge. This is just what I've seen. Multiple of sales ever used as a formula. What do you mean by that, Robert? So Robert asked, is multiple of sales ever used as a formula?
And Robert, feel free to unmute yourself if you want to get more detailed.
Yeah. So do you mean top line sales? So your total revenue, right? So like 6 times sales. So yes, so most multiples are a formula, right? 2 times EBITDA, 3 times SD, 4 times revenue, 4 times sales. So yes, it is used as a multiple. The question is it used appropriately as a multiple, which is a whole different conversation, right? So 6 times sales, 6 times top line sales. I can't think of an industry that would support that outside of maybe tech, right? Because what you're saying is if every dollar that was made, that was sold, was used to pay back the purchase of the business, it would still take 6 years to get to break even, right? So if you sell $1 million in sales a year and you're charging $6 million for that sale, but you're only putting $100,000 to the bottom line, which is still a healthy business, then it would take 60 years to pay off the purchase price, return on investment of 60 years. That's not really feasible. So top line sales is very rare for just that purpose. Right? It's saying, okay, what times my top line, my total sales, would a reasonable purchase price be? Maybe 0.3 or 0.4 for most, service or manufacturing, but really it's just a reflection of how much cash flow are they generating to the bottom line, because the bottom line is what determines a return on investment for all but a few very specific industries. Does that answer your question, Robert? So someone asked, is it possible to sell a business with client list and equipment without selling the company brand and name? Yes, that's a great question, and absolutely, right? So if you say, okay, I'm going to sell my business, but I don't want it associated with me anymore. That's the value of that asset list, right? When you're saying an asset sale, you are identifying the assets available for sale. And if you want to omit things like trade name, you can do that. The difficulty there is that goodwill, my definition of goodwill, encompasses all of the assets that might contribute to cash flow. And so if you're talking about the goodwill value of a very specific intangible asset, there's a lot of room for negotiation there, right? Because that might affect the cash flow as a whole, but in a way that we're really not sure of, right? Or that you might think, hey, my trade name doesn't have anything to do with my cash flow. And the buyer might say, hey, your trade name has everything to do with your cash flow. I only want to pay for the physical, tangible assets, because without that trade name, I'm going to have to rebuild the brand of this business. So, it's some negotiation there, but certainly possible. Do most deals include a non-compete clause? Most do, right? They don't want you going out and using the money that they just paid you to start a competing business. So most have a non-compete clause kind of wrapped into a consulting clause. So they say, okay, I want you to remain available to me for phone calls for the next 2 years, up to 10 hours of phone calls a quarter. And as part of that, you will not go out and compete within a 30-mile radius. It is negotiable, yes, very much so. You can negotiate how far, geographically from the original location. You can negotiate with time, 5 years, 3 years, 10 years, or you can just negotiate, hey, I'm not going to sign that. I want that opportunity. It might decrease the value for the buyer, because then they're looking at a trained, potential competitor that they are funding with the purchase, right? They're giving you enough money to go out and compete with them. That might be a tension point, or they might not care. They might say, sure, bring it on. So everything's negotiable. Other questions? All right, like I said, my information, I put my email in the chat. So the SBDC give you, if you're not familiar with us, we're federal, state, and locally funded. We're hosted by different organizations. So I'm hosted here at AvCog in Central Maine. We have, 15 or 16 advisors throughout the state with access to various local resources as well. If you're not familiar with your advisor in your area, I'd invite you to visit our website and check us out. We're a free service. Most of our advising is done one-on-one, and we're already paid for by your tax dollars. So you may as well use us. And that's what we're here for. Love to hear from
Hey, Ray, I do have one other question.
Please, yes.
We've been in business for 20 years. It's been increasingly great every year. We've shown great progress. With this down year for everybody, this COVID, how much is this COVID year going to affect everybody's bottom line for selling a business?
Great question. And frankly, I wish I had a straightforward answer for you. I think part of it's going to be determined by how well you've reacted compared to the industry as a whole. But I think also, more importantly, everything that has happened is not unique to you and your business. And why I think that's so important is that every lender out there, every buyer, every investor, every attorney, every accountant understands what happened in 2020, right? So looking at the 2020 fiscal year is going to be important because it still has some benchmarks. It still shows how well you weathered the storm, but it can't really be compared to 2019 or hopefully 2021, right? So it's going to be understood that that has an asterisk with it. Our goal, our hope, of course, is that 2021 is a great rebound year and everybody sees a jump back up. But yes, I can't imagine it will have a huge impact in the buyer brokerage world and seller brokerage because it's so universally understood, right? Especially if we can show that 2021 being more successful. And you can identify and isolate 2020 as the exception.
Thank you very much. Appreciate that.
Still waiting and hope, I guess. So any other questions, please feel free to reach out. Otherwise, I'll let you go and have a good afternoon.